What's up, guys? Cryptotrendtrader just wanted to make a quick video. It's no secret 2023 is off to an amazing start. We loaded up on Tesla, magic internet money, sweatpants, and China. And those trades have worked out better for the human race than yoga pants. Normally we bend the market over and take everything it has to offer before calling it an Uber and sending it on its way. But this time is different. We've been gently extracting the market's milk more efficiently than one of those electric pumps. But before we sit back, kick our feet up, and enjoy that mother's milk, I decided to find something sweet to go along with it. So I was digging around in the pantry and found this gem. Ticker symbol, You know it. The chocolates with the thin candy shell. Melts in your mouth, not in your hands. That's right, we're taking a look at M&Ms, or whatever 3M is. But all joking aside, I didn't find this in the pantry. It was in the trash where it belongs. But like they say, one man's trash is another man's treasure. So why not take a look? Alright, so here we've got 3M on the daily, and as you can see, we reached our maximum peak, the all-time high, back in January of 2018, and it was on a pretty steep decline afterwards until it finally bottomed out in March of 2020 with the Rona dump. It then went pretty parabolic and regained quite a bit of those losses, but it never actually made it back to a new all-time high. And once it topped out here in about May of 2021, it's been melting down ever since, and we'll notice here that it's actually put in a new low. So let's go ahead and zoom out to the monthly chart and see what's going on here. So if you've been hanging around for any amount of time, you know that typically I talk trash about things that are not putting in new all-time highs as cycles progress. So from 2018 to now 2023, it's basically been 5 years since 3M put in an all-time high. It's been publicly traded since 1962 and has basically been in a parabolic uptrend its entire life cycle. But we don't need to pay attention to what's been going on for all that time. We want to pay attention to this little area right here. So if we zoom into this low right here from 2009, right around $41, and then we put a fib in place to the all-time high at $258, that's our blue fib right here. And then we also have a little bit of a swing low right here at $69 in October of 2011, and that is our green fib as well. So now we want to pay attention and see, is the market actually respecting those fibs? And as we can see from the all-time high in blue right here and green, we came back down, we retested the 236 in green, we broke down from that and hit the 0.5 in green as well. And then we actually wicked down slightly lower to the 618. After that, we came up here and put in that lower high, and then we've been melting down ever since. So we see some clear reactions on the green Fibonacci's, but now we want to pay attention to the blue Fibonacci's as well. So here it looks like basically a giant topping pattern or head and shoulders. And once we broke down below that 236, we stopped shortly at the 382, and that was our previous level from 2020 lows. And now we have broken through the 382, and here we are at the 0.5 here in blue. And that is our Charles Dow theory retracement, 50% of the move from the macro low at $40 to the all-time high at $261. We have given back 50% of that move, and currently 3M is trading at $102. So at the moment, it is down roughly 60% from its all-time high. Not only that, but we haven't seen prices this low since 2013. So at this point in time, anyone that bought 3M between 2013 and 2023 is a loser. Not like at life, but they're underwater in their position, trade, investment. So we have to be careful because there is quite a bit of potential selling pressure. But that being said, now that we've hit the 0.5 level right here, realistically, what we would be looking for is either a deeper retrace down to the 618 or potentially a bottom and reversal. Now, let's say hypothetically we do reverse from right here. It doesn't mean that it's a macro low and we want to just hold this thing forever, but there's definitely a little meat on the bone for a bounce. So this area right here where we topped out in 2004, we then saw a slightly higher high in 2007, then a lower low, and then finally one more touch of those highs in 2011 before finally breaking out of this range right here. So if we just grab our rectangle tool and just kind of spread that out, we can see there's quite a bit of consolidation or price action that took place inside of this yellow box right here. So while it is possible that we do come down here lower over time and re-enter that yellow box and then consolidate back around in that area, it's very unlikely that we just blast to the downside straight through all of that. So that makes me think that the 0.5 retracement could be a good area to take at least a short to medium term scalp. Now, I'm not saying that we don't want to hold 3M. It's actually a really good stock over time. This is one of the dividend aristocrats, which means they have consistently played a dividend for decades, and that dividend has consistently gone up. And in this particular case, the dividend is actually pretty nice. So if we just turn off our drawing tools for a minute here, we can see that it kind of looks like we're in the middle of nowhere. And the move that I'd be looking for is potentially something along these lines. We broke down from the 200s, we back tested those 200s and then went to a lower low. So what I'm normally looking for, rather than just blindly catching knives, is key support levels based on Fibonacci's, key moving averages, and then also bullish divergence. And it's never a bad idea to pay attention to big volume spikes like this as well. So here we saw a big volume spike on the selling and then also on the buying as well. And then from there, we back tested the 200s and failed to recapture them, at which point in time we broke down to new lows. So we have a high, we have a low, we have a lower high, and now we're consistently putting in lower lows. So it may not be the perfect time to jump in on this one, but we want to keep it in on our radar. So if we just switch over to our weekly next, we'll see that we were in a very strong uptrend. We lost that uptrend, attempted to reclaim it, and then failed and rolled back over to the downside. And now we're putting in new lows. So I'm not necessarily saying that this is the perfect time to buy 3M and we're going to actually capture the exact bottom and then it's just going to go straight up from there. But for a long-standing company that's been around since the 1960s, it's consistently paid a dividend and all it has ever done is gone up and to the right. It's off the all-time highs by over 60%, and we haven't seen prices this low since back in 2013. Might not be a bad idea to park a little cash in here and sit back and enjoy that 6% dividend yield. The best part is we know that they've gone through quite a bit of rough times, and they've never had an issue not only paying their dividend, but also increasing it regularly as well. So that gives me confidence not only in the actual stock, the company's performance, but also the probability that they will continue to be able to pay that dividend going forward, which is very important because if you buy into a stock based on the dividend and you're looking for that steady income and then suddenly they suspend that dividend, it destroys the whole purpose for you investing in that stock to begin with. So let's go ahead and slap a Fibonacci from the top right here down to the first low and then see what happens. So it bounced back up, got above the 618, consolidated at that level for a little bit, and then broke down from there. So what if we just extend that down and say, oh, this is actually the bottom, that's where we're at right now. We see that we initially came down and found some support around that 236, which corresponded with the 618 here in green. We bounced back to the upside, and then we came back down and found support around that level again. We then got a nice bounce back to the upside, proceeded on down, and then we put in what could potentially be our macro low. So the important thing for us to pay attention to is, what does this have to do for us to think that actually the low is in, and now we're just going to do another retracement back to the upside? Well, the initial target that we need to hit is the orange 236 right here, which is at $125. So if we're basically buying the low at roughly $102 with a potential move to the upside of 25%, all we need to do is just look for a stop loss that's appropriate to those levels because we know there's roughly a 25% upside on this move. So if we just zoom out here a little bit, I think it's safe to say that if we break down inside of our little yellow channel right here, that once we're back inside that area, there's a good possibility that we're going to actually revisit the bottom of it. So if we just take our trading tool right here, and what we're looking for is a back test of the 236, so that's going to give us roughly 21% upside. So we're going to go ahead and set our stop loss down below that zero line. So if we go back down here, revisit the lows and take it out by more than a couple percent on like a daily close, let's say roughly $97, we can reevaluate the trade and potentially look for a better entry later on. But that gives us 21% target to the upside with 5% stop loss. And that is roughly a 4-to-1 risk reward ratio. So we're trading against the trend, which means we need at least a 3-to-1 risk reward ratio. And in this case, we're getting 4-to-1 risk reward ratio. So there's definitely some potential not only for upside, but also to make about 6% on the dividend while we're holding this. So while I'm not convinced that we're just going to go back to new all-time highs, there's definitely some potential to at least go back to the upside. So the last thing I want to do when we take a look at this is just essentially start connecting the highs and potentially the lows and see how that looks like it's going to pan out. So we're just going to take our parallel channel tool and we're going to take it from the macro highs, and then we're just going to go from that previous high in 2021. And then we'll go ahead and extend it down to the bottom of the range. And depending on if we use the closes on the daily or some of the other time frames, or if we use the wick down here as well, might get some slightly different results. So we're going to go ahead and use the wick for right now because we do see quite a bit of confluence along the way with the heart line. And that gives us potentially a lower low down here of like $93, $94. But the thing is, because we're essentially trying to catch a knife on this one and we're looking to buy it near the current lows, we don't want to have a big stop loss because there's definitely a possibility we could be wrong. As a matter of fact, everybody that's ever bought this thing expecting that the bottom is already in has been wrong. So we don't want to join that club. What if we go ahead and just pull this up here and go from the close right here in March of 2020, and it looks like we're already at the bottom. So we're going to go ahead and take a stab around this area. We're looking for minimum upside potential of 21%. If the trade starts to go in our favor, we're going to take some profits along the way, but realistically, we're looking for an actual like deeper retrace. So we know that the orange Fibonacci is essentially from the top to the bottom. So the initial pushback up would be regaining 23.6% of that move. And then the 382 would be roughly 38% of that move. And that would give us a 39% upside. And then after that, we can start looking at like the key areas here, the 0.5 in orange at about 161. So we have some targets, we have some potential trade setups, we have a clear case on why we would potentially want to scalp this, trade it, or even own it over time. It's definitely a risky play, and there's a reason this thing has been discarded. There's also a reason, I'm sure, that we haven't put in a new all-time high since 2018. So I don't necessarily want to marry this thing, but just because we don't want to marry it doesn't mean we can't have a good time. So I'll be keeping this one on the radar, and honestly, I think you should too. Obviously, it's not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. So yeah, that's it. Just want to take a quick look at ticker symbol MMM, 3M company. And while I'm not quite convinced that the bottom is in and we're going to be buying the absolute lowest low ever to low, there's definitely some opportunity here. And with the 6% dividend yield, an extremely good track record, as a longtime member of the Dividend aristocrats, 3M has some definite potential. The key is to capture that 6% dividend yield without the stock actually going down to where we lose more than 6% of our initial investment. So yeah, that's it. It's a good stock, but obviously the market's been pretty brutal to this one. But there's definitely some opportunity. All right, later.